For Financial Accounting Part 1, for the midterm, there are 4 chapters that will be covered, from Chapter 1 to Chapter 4. And there are 3 types of questions that will cover all the materials in the 4 chapters. And the first type of question, you will be given a list of the transactions, and you will be asked to prepare the journal entries, including the adjusting entries at the year end. And to solve this type of questions, you need to figure out 3 things. So number 1, you have to read the question and find the relevant period that the question is asking you. And the second thing you have to figure out is at which date you have to book the journal entries. And after you have figured out the period and dates, do your calculation and book the journal entries. JE. So now let's solve this problem using the 3 steps. So let's read the question first and the transactions one by one. So in the first transaction, on November 1st, 2007, the company purchased a check for $40,000 cash, and the estimated useful life of the check is 5 years. And we are asked to prepare the journal entries to record the original transaction, the year-end adjusting entries, as well as the cash transactions until December 2009. So the relevant period for the first transaction, the purchase of the check, is from the December 1st, 2007, when the check is purchased, until December 2009. And then we need to figure out the dates of the transactions. On December 1st, (2007), we have the purchase of the check. And we know that for the check, which is a depreciable asset, we have to book the depreciation expense at the year end. And the year end of the company is November 30th. So on November 30th, 2008, which is 1 year after the check was purchased, we have to book the depreciation. And the same thing will also happen in 2009. So on November 30th, 2009, we also need to book the depreciation for the whole year. So now after we have figured out all the relevant dates, then we can book the transactions. So at the first transaction, December 1st, 2007, when we purchase a check, we debit a check. And because we pay cash, we credit cash. And the check was $40,000. So we debit check $40,000 and credit cash $40,000. And then we need to book the depreciation on November 30th, 2008. And the check was $40,000. So the depreciation expense per year equals to $40,000 divided by its useful life, which is 5 years. So the annual depreciation expense is $8,000. So after we have done our calculation, our journal entry on November 30th, 2008 is debit depreciation expense of $8,000 and credit accumulated depreciation track for also 8,000. And on November 30th, 2009, the depreciation expense for the period is exactly the same as what we have calculated, which is the $8,000. So the journal entry will be the same as November 30th in 2008. So we debit depreciation expense for $8,000 and we credit accumulated depreciation for the check for $8,000. And in November, nothing happens. We only book the depreciation at the year end. So there is no journal entry required in December 2009. Then we can do the same thing for the second transaction. So on June 1st, 2009, the company borrowed $50,000 from Bank of Montreal at an interest rate of 6%. And the principal is to be repaid in 1 year, and the interest is payable the first of each month. So the relevant period for the transaction is from the June 1st, 2009, when the money was borrowed, to December 2009. So when the question says December, we can assume that is at the end of December, which is December 31st, 2009. And then we need to figure out what's the relevant date of the transactions. So on June 1st, 2009, we borrow the money. So that's our first transaction. We borrow money. And the interest is payable the first of each month. So from July 1st and on August 1st, on September 1st, October 1st, November 1st, and December 1st, we all need to book the interest that we have been charged. And don't forget that November 30th is our year end. So on November 30th, 2009, we have to book accrual interest. After we have figured out the relevant dates, we can book the journal entries. So let's look at our journal entries. On June 1st, 2009, we borrowed the money. So when we borrow the money, we receive cash. And we have a loan payable. So we have a liability of $50,000. So this is our first journal entry when we borrow the money. And from July 1st, August 1st, September 1st, October 1st, and November 1st, we all need to pay the interest. So what we need to do now is to calculate what's the monthly interest and book the journal entry. The monthly interest equals to our principal multiplied by the interest rate and divide by 12 months. Because the interest rate 6% is our annual interest, so our monthly interest for this question equals to the principal, which is 50,000, multiplied by the 6% and divide by the 12 months. So our monthly interest equals to $250. So on July 1st, August 1st, September 1st, October 1st, and November 1st, we all need to book the same journal entry, which is debit interest expense of $250 and credit cash of $250. And don't forget that on November 30th, 2009, which is our year end, we need to book accrual interest for the period from November 1st to November 30th. So we debit our interest expense and we credit our accrued interest. Our interest payable of $250. So here is our year-end adjusting entry. And don't forget that we pay the interest on the 1st of each month. So on December 1st, 2009, we'll pay the interest. So the journal entry for the cash payment is to debit our interest payable of $250 and credit cash of $250.